My name is Jake, welcome to the channel. In today's video, we're going to do a Review My Pie video where I review subscriber portfolios. I've been doing this for a handful of years and I actually just noticed that it's the 60th video of this series. It's a little bit different than the other videos that I create here on my channel. I do these Review My Pies about once a month. And I just want to say I really enjoy reading your emails. And a trend that I've noticed is that most people who reach out have a similar goal in one way or another, where they're trying to either entirely or partially replace their active income with passive income. And I think that's an incredible thing, having done that myself, where I'm actually living off of my portfolio. It's great to see other people from all walks of life. As you can see here on your screen, I'm actually traveling this week. We spend part of the year here in Austin, Texas, and we spend the other part of the year up in Utah, where I grew up. We're going to be escaping the brutal summer here in Austin, and we're going to be moving back up to Utah. And we spend our time between both places. But anyways, so in today's Review My Pie, we're going to keep the same format. I'm going to go over a question from a 38-year-old here in the US, and we're going to take a look at three portfolios. The first is from a 24-year-old here in the US, the second a 23-year-old from Malaysia, and then the third a 58-year-old here from the United States. And as always, everybody, the timestamps will be in the description below, as well as the portfolio links will be in the description below. And as always, everybody, I'm not a financial advisor. Please don't take what I'm saying as financial advice. It's just merely for your entertainment. And really quick, if you are not quite sure where Malaysia is on the map here, if you scroll over here into Asia, you can see here under Thailand, under the Philippines, you got the country of Malaysia, right here by Singapore. One of the things that I've noticed as I've looked at maybe, geo arbitrage, looking at other countries to consider for early retirement, or at least to, maybe slow travel where I go there for a couple of months, Malaysia always pops up because it's a very friendly, clean, from what I heard, I can't speak from firsthand experience, clean and welcoming and safe country. A lot of these countries here with the Philippines, Singapore, Malaysia, Thailand, a lot of people really, really enjoy these countries. And it's definitely on my bucket list. I would love to come and visit some of these countries here. It's just a little bit difficult with a toddler to go into a foreign country that I've never been to, and country that I don't speak the language. But if you're from Malaysia, or if you've been to Malaysia, leave me a comment and let me know what you think. I've been to Thailand, but I also would like to go to Bali. I have Bali on my bucket list, but would love to hear what you think. Have you been to Malaysia? Have you been to this area? Do you enjoy it? Would you recommend it? Love to hear your thoughts. All right, let's take a look at this question here from John. He writes, "Hi Jake, thanks for your videos. I am a new subscriber. I'm 38 and have built up a portfolio to about 500K, 130K taxable brokerage, 10K HSA, 230K Roth, 130K 401K. I have total control of investments in these accounts. My goal is to be able to only work 1 to 2 days a week in my 50s and be retired by 60. I have to afford this in part by using my taxable account for dividend growth and a rental property, and hopefully no debt and mortgage." Okay, great. I have 0 ETFs, a cardinal sin on this channel. I think you've noticed a trend here. I've had moderate success in trading individual stocks and even doing some options trades. And while I enjoy this, I want to start being a little safer and more passive. I'm currently building my cash pile and want to start buying ETFs. However, I have been holding off because I believe we are going into a recession. How would you execute a transition into ETFs, and what would be your strategy for each account? Would you cost average slowly in? Would you do more growth versus dividends in the retirement accounts? Thanks for your ideas, John. Well, John, thank you so much for reaching out. I think this is something that everyone struggles with when we see that the market is at all-time highs. I mean, the Dow just surpassed 40,000 for the very first time. When you look at the market and see that it's at all-time highs, it can be very stressful and very depressing when you're thinking about investing new money, because it's like, okay, well, is the market just going to crash? It can be really frustrating, and it could look a little like this. Gosh. Oh man, the poor guy. He just wanted to enjoy a cheese fondue. Oh man, life happens. Anyways, John, first off, I just want to say I think it's incredible that you've built your portfolio up to $500,000. You're diversifying your assets across different account types, and that you've done that all with individual stocks. I think it's very wise of you to start looking at how you can diversify your portfolio and see how you can maybe protect some of the capital that you've accumulated over these last couple of years. First off, before I get into the core part of your question, something that you may want to consider if your goal is to be financially independent, it looks like you have a good amount of your net worth in tax advantaged accounts, almost 400,000. You may want to consider coasting in your retirement accounts. It doesn't look like you really need to max out your retirement accounts any longer, and you'll be able to amass a net worth or an amount of about $1.5 to $2 million if you were just to invest into, standard index funds compounding at around 8 or 9%. So there's something you may want to consider, that Coast Fire in your retirement accounts may be an option, and then you could allocate new capital into, the minimum amounts in your HSA, your Roth IRA, and then your taxable accounts. Something to consider, a lot of you are probably not going to understand what I just said, because this isn't the way that you're supposed to think about this. The way that the world teaches us to think about this is to work, and do the same thing and then we retire. It's a different way of thinking about things. So read up on Coast Fire, and I think that may be an option for you in your retirement accounts. You may be surprised that you have more options than you might think. In terms of timing the market and transitioning from one asset into another, the simple way of looking at this is you can't predict the future. So the decision that you're going to make, you have to be satisfied with the decision that you make one way or another. And that's just the reality of life, is we can't predict the future. And so you want to make sure that you're making the best decision possible with the information that you have in front of you. And the way that I like to do this is I always look at things from a time in the market versus timing the market perspective. And so you may want to consider doing what I always say is, if you have this dilemma, hey, I'm looking to lump sum invest, or I'm looking to change strategy, the way that I look at this is I never look at it at a all or nothing, black or white. I always look at it in a balanced approach. Well, maybe I do a portion today, and then I do the other part, or maybe 50% today, and then the other remaining 50% over 3 to 9 months, as an example, or 6 to 12 months. So that's the first question when it comes to averaging in slowly or lump sum investing. And that goes just generally across the board. So it's not just specific to this scenario. So if you're thinking about that, that's how I view this. The second part of John's question here, when it comes to, which account type would hold what type of strategy, growth versus dividends, and do you have dividends in a retirement account or in a taxable account? The conventional wisdom is that you only have dividend stocks or ETFs in retirement accounts. And I am living proof that that's not always the case. It really, really depends on the individual and your goals and your time horizon. And I could see a case. Now, this is why, guys, this is why investing is so difficult, is you could have there's pros and cons for both scenarios. You could have growth in your retirement accounts or in your tax advantage accounts, and the same thing for your dividend ETFs. It really comes down to your strategy and what works for you. What I would recommend is, don't look at what the norm is and base your decision on what the norm is, but rather I would look at your own particular situation and decide, okay, is this right for me? Does this work for me? Because if you're planning on retiring earlier or living a different lifestyle than the quote unquote norm, well, you have to think and act differently. Okay. And so that's why, if you're planning on being completely normal, retiring at the age of 65, and you're going to retire after the age of 59 and a half, well, yeah, you could have the majority of your investments, your dividend stocks in a retirement account, and that could work very well. But you could also make the argument that you could have growth stocks in a retirement account, and when you sell them, you're going to pay zero taxes. And I did a video a couple weeks ago where I talk about that, and the mathematically, you're probably going to be better off focusing on growth in a retirement account and then selling and rebalancing your portfolio. So with that understanding, I could see a case for both. And that's why this question is so difficult. And without understanding, some of your other goals, it's really hard to say you should do one way or the other. What I would recommend is I would look at your goals, see what's important to you. If you know that you're planning on living in, off your portfolio in early retirement, you want to utilize your taxable accounts differently than what the norm would be, right? So don't get caught up on, dividend stocks can only go in a retirement account. I wouldn't think about it that way, okay? So I know that that's not exactly telling you what to do. What I'm trying to do is help you learn how to think about this so that you can make the best decision for you and your particular situation. So John, I hope that helps. And anyone in a similar situation as John, I hope that that's valuable for you. And sometimes it's just not a black and white answer. Sometimes it's a little bit more nuanced than that. And I hope that adds a little bit of context and helps you understand, how you can think about this versus telling you what to think. Thanks, John, for sending over your question. All right, the first portfolio is from Rory. He writes, good morning. Well, good morning to you. Hi, my name is Rory. I am 24 years old, soon to be college graduate, starting out my dividend investing journey after coming across your channel. Based on the information I've learned from you and other sources I could find, I built this starting portfolio with the aim for more growth right now, as I'm still quite young and I envision my time horizon to be around 30 plus years or so. Hope to open to any and all suggestions. Thank you for being a source of guidance for everyone in this community. Well, Rory, thank you so much for sending over your portfolio. I noticed that you sent over another email saying that you're investing about $100 a month. This is so exciting, man. You're 24 years old. Your life is all in front of you. You want to make sure that you understand that you're not going to have everything figured out, and you're probably going to change your mind a handful of times. You're probably not married. You probably don't have kids. Life hasn't quite yet happened. And so the best advice that I can give you, if I was, talking to my younger self over 10 years ago, the number one thing that I would say, not without putting a lot of thought into this, is just, what? Don't worry. Don't worry about all the little nitty-gritty things. Enjoy the journey, because it's not just about the destination. 30 years is your lifetime. 30 years is a huge percentage of your actual life here on earth. And you want to make sure that you're enjoying the journey and that you're not sacrificing other things in those 30 years. For example, having experiences with your family, going and exploring the world, doing it responsibly, not going into debt, but just don't try to think that you're going to spend the next 30 years on top ramen. Enjoy the journey, because it's not just about the destination. All right, so let's take a look at your portfolio. Your portfolio is up 100% that you put together here. You have a good starting yield. You have 18 holdings, which I like, and you have a very low expense ratio. So this right here, right off the bat, the stats look great for what you're trying to do. When you're thinking about a 30 plus year time horizon, the dividend yield should not be a drag, because this is likely going to be, I guess this is a very good point, because if you know that you're going to be working for the next 30 years, you likely want to make sure that you're optimizing for tax efficiency in a Roth IRA, a 401k, and that's going to greatly impact how you view this and how you're investing. What I would recommend to you, if you know that you're going to be working or you plan on working for 30 plus years, that means you're probably going to retire at the average age, after 59 and a half. Okay. So what that means is you can access tax advantaged accounts. Okay. And so the number one thing that you want to be thinking about is how you can optimize these different account types and what strategy you're going to have for each account. Okay. This is so important. Okay. So much more important than picking the right stock. Okay. This is unconventional wisdom here. When we're taught about investing, it's all about picking the right stock. No, that's kind of, that comes later. That's not as nearly as important as understanding your overall strategy. Kind of like the question that we saw from John. You remember how John had his HSA, his Roth IRA, his 401k? That's what you, Rory, and everybody else in a similar situation, that's what should be front and center for you, is understanding how you're optimizing your tax advantaged accounts and how you're viewing this. Because the way that you want to look at this is each individual account should have its own strategy. I'll give you an example. My wife and I, we invested in our 401k, Roth IRA, HSA. Our strategy with our retirement accounts is purely growth. I don't have a single stock in those. I only have index funds. They're all focused primarily towards growth. I have almost 40% into VTI, 40% into VGT, and a little bit of international, a little bit of real estate. That's all I have in my retirement accounts. Okay. In my taxable account where I have a different strategy, it's entirely different. It's a different focus. Okay. And so what I would encourage you to think about is how you're viewing these accounts and how they're going to, work towards helping you reach your investment goals. Okay. And if you don't know your investment goals, that's where you got to start first. Okay. That's so important. And I really wish that somebody would have sat me down at a younger age and told me this and helped me understand this. I learned this, and I'm sure the majority of you watching learned this at a much later stage in life. If you can figure this out earlier, the earlier you can figure this out, the better off you're going to be. Trust me. Okay. So, all right. So you got 18 holdings in here. You got core, tech, restaurant. This looks very, very much like a Joseph Carlson type setup here. Kind of. Kind of. It's with the icons. This is kind of something that I've seen with Joseph Carlson in the past. But anyways, you got core at 70%. I like to see that. You got tech and the remaining at 5%. Okay. Right off the bat, I actually really, really like this. And it seems like you follow my channel because it looks like you're following the core and satellite approach, which I really, really like. All right, let's take a look at what you have in your core portfolio. You got SHD, VGT, okay, SPYG, VTI, and DGRO. Okay, these are all really great ETFs. I own all of these in one fashion or another. I own SHT, VGT. Like I said before, VGT and VTI, those are my largest holdings in my Roth IRA. Now, something that you want to understand with SPYG, this is not one that you're going to live off the dividend. Very, very unlikely. This one is more kind of like VGT and VTI, where you invest in it more for the diversification and the growth. And then later on, you would likely look to sell out or rebalance out of these and then do something with it. You would either buy a house, buy a car, or reallocate into a higher yielding asset like an SHD, for example. So make sure that you understand your strategy. These are all great, but they're all great vehicles. These are investment vehicles, but they're designed for different purposes. And it's important that you understand what the purpose of this what this investment is for you. Are you going to hold this and then rebalance in the future? What's your goal with these ETFs, right? So the next one here, you got tech. What do you have in tech? Apple and Microsoft. Okay, great. I think that's fine. You want a little bit extra exposure to those. Okay. What do you got here in restaurants? Starbucks, McDonald's. Okay, great companies. Right now, in the short term, you're going to see a lot of, turbulence. Like Starbucks right now is really under fire. McDonald's is under fire, because a Happy Meal is like the cost of a sit-down restaurant 5 years ago. Just the cost of everything has gone up so much. So they're getting a lot of bad press lately. Real estate, what you got in here? You got Vici. Okay, so yeah, this is a totally a Joseph Carlson inspired portfolio, which there's nothing wrong with that. Vici at 5%. You really got 5% in that? Okay. I think it's a bit much, but okay. You got financials. What do you got in here? MasterCard, Visa. I think that is fine. Okay. Financials. What do you got in consumer? Consumer, you got Costco, Estee Lauder, Nike, and Pepsi. Okay. So a lot more in Costco. Okay. What do you got in industrials? You got Union Pacific and Waste Management. I love it. I love this. I like this a lot. Okay. Well, I think, first off, right off the bat, I like the strategy. I like that you're following the core and satellite. All of the individual companies are absolutely fine. Just to understand, the satellite positions, they serve a couple of purposes. One, to help round out or balance out your portfolio based off of your goals. Another reason is it's really, an emotional buy, right? The fact that you have Vici in there, the fact that you have, Starbucks and McDonald's, they're great investments, but they're more of an emotional buy, an emotional investment. Okay. And there's nothing wrong with that. And especially there's nothing wrong with it when you have your portfolio like this, where you're balancing out your risk. Okay, I really, really like that. Your dividend yield is great. The expense ratio is great. I like this. So I guess the thing that I would say here to help spruce this up a little bit or help you think about how you can strategize your portfolio for the coming years, potentially I would even consider having two portfolios. Okay, because you have two strategies in one portfolio. There's nothing wrong with that. But to make it simpler is I would consider having a buy and hold portfolio where your goal is to live off of the income, and another portfolio that's a buy, hold, and rebalance, also known as more of a growth portfolio, to help you kind of strategize a little bit differently in how you view these different portfolios, because this investment approach, they're very different. The buy and hold is a little bit different, or is very different than the buy, hold, and rebalance. So you may want to consider having another portfolio that's categorized as a growth portfolio that you don't plan on selling in the future. That may be something to consider, but as it stands, I like your portfolio. I think you're off to an incredible start in life. The thing that you want to remember is you're going to end up changing your mind quite a bit. Patience is probably going to be key here, especially when you have 30 years to go. Just understand that you're going to change your mind, and that's fine, but I think you're off to an incredible start. Rory, thank you so much for sending over your portfolio. All right, let's take a look at the second portfolio from Oscar. He writes, "Hi Jake, my name is Oscar from Malaysia. Today I finally picked up my balls to ask you to review my pie." Okay, that's cool. First, I'm 23 years old. I'm planning on living off my portfolio at 35 years old in around about 12 years. I'm not a high earner now, but I've decided to move to another country to try to earn more money. I think that's a great idea. I'm using a platform called Moomoo based out of Singapore. That's why I only can save up like a year investment fund, then transfer to that platform. Otherwise, okay. I'm currently dollar cost averaging and invest into 3 ETFs, VYM, SHD, and DGRO. Do you think I could invest in a JEPI for more risky and earn more dividends for a 12-year time horizon? I hope that this information is enough for you to give me advice. Appreciate, stay safe and healthy. Hope to hear good news from you soon. Well, Oscar, thank you so much, man. I appreciate reaching out. I appreciate you reaching out. And there's a couple of things that I want to talk about. So first off, I think the 3 ETFs, VYM, SHD, DGRO, I don't think anyone can go wrong with those. Those are great ETFs, dividend ETFs, if your goal is to live off the income. Okay, you're not going to 10x your investment portfolio, the value of your portfolio. It's very, very clear. Usually, people invest into VYM and SHD usually when they've already accumulated their wealth. Okay, usually once you've accumulated your wealth in life, then usually people will transition or rebalance into VYM and SHD. Now, DGRO is great because DGRO is kind of a nice balance between growth and a higher than market average dividend yield. And so combining the three, I think you're balancing out your strategy where you're going to get a little bit of a higher growth rate on the dividend and a higher than market average dividend yield. So it's good that you have the DGRO in there as well. That's why I talk about DGRO so much, because it balances out the growth, especially for younger people who have a longer term time horizon. When it comes to JEPI, now, it's important to understand that JEPI is a cover call ETF, okay? And cover call ETFs cap the upside. So in a bull market, you're not going to participate as much in the capital appreciation. Now, it really comes down to understanding what phase of life you are in. Are you in wealth accumulation or wealth preservation? Wealth preservation, generally what you'll do is you'll transition out of growth and you'll transition to a more conservative approach where it's more of an income-focused approach. But usually you'll do that once you've accumulated your wealth, once you have the money and you want to transition from accumulation mode to preservation mode. JEPI is very, very clear a wealth preservation and focused on income. People who should invest in a JEPI are only those who have money today or in the very short term are going to plan on living off of the income from JEPI. Did you understand that? So whether you're from Malaysia, Ohio, Omaha, the boonies in, I don't know, where are the boonies? Somewhere in the boonies. I don't know where that is. Maybe you're in, I don't know, in Kansas somewhere. Or maybe you're in Chicago or in New Jersey or Los Angeles. I don't know where you're from, but it's important that you understand that regardless of where you're from, it's important to understand if it's a good idea to invest in a JEPI for your specific situation. Okay. And so unless you plan on living off of the income from JEPI in the next 5 years, you don't need it. It doesn't make any sense. You can always add it later. A lot of people think they're going to miss out. Like, don't FOMO into these covered call ETFs, guys. Don't do it. It doesn't make sense. It's not worth it. You can build your wealth. Once you've built your wealth, you can then look to diversify and generate income in a covered call ETF like JEPI or JEPQ, as an example. Okay, so that's why, and I've talked a lot about this on my channel. It has a lot to do with the total returns. Even if it's in a tax advantaged account, you're going to get likely higher returns focusing somewhere else and then transitioning into these later. Okay, so JEPI is not really one that you dollar cost average into longer than 5 years. Okay, so you have a 12-year time horizon. What that means is in 7+ years, you could then look to then slowly start adding covered call ETFs for more income. And when you say risky, the only risk here is that the income could go down as market volatility goes down because they're tied to volatility. And the risky part here is you're forfeiting potential growth for income today and the income that you don't need. Okay, and that's why I always recommend put off investing in these covered call ETFs until you've accumulated your wealth and then you're looking to preserve your wealth. Okay, understand? Perfect. Well, Oscar, thank you so much for sending over your portfolio here. Like I said, VYM, SHD, DGRO for a 12-year time horizon is absolutely fine. I think no one can go wrong with that. It really comes down to now on focusing on things that you can control, cutting your expenses, staying out of consumer debt, and looking for new ways to make more money so that you can invest more into your portfolio. So yeah, Oscar, thank you so much for sending over your portfolio. All right, the last portfolio is from Terri. Hi, Jake. Love your channel and your approach. You're one of the reasons why I know dividends are right for me. Well, Terri, thank you so much for saying that. I appreciate you saying that. I'm 58 and looking to retire at 59.5 or 60. I have a pension that will yield about $60K a year, and I want to supplement my income with dividends versus the traditional 4% rule. My goal is to get at least 4% in yield and stay ahead of inflation and try to have a little growth to increase the portfolio. I have no debt and am location independent and plan on traveling once I retire. I actually don't have a pie, but Google Sheets. I hope you can take a look at it. These are not my current investments, but what I'm aiming for. SHD and SWVXX are in a taxable account. The others would be in a traditional IRA once I combine. I have some JEPQ and JEPI and want to know if this is an okay time to start, even though I may be 2 years from retirement. I figure I could reinvest if I'm not using the income. I appreciate your thoughts on getting yield from the covered call ETFs and still getting growth. I ignore SVGOV, and I was using it to estimate funds I currently have in some T-bills. P.S. Look at the fourth tab, combined accounts. Okay, cool. So, well, Terri, thank you so much for sending over your portfolio. I think it's incredible that you're going to be getting a $60K pension. You know, that just means that you put in the time and effort, you put in your time, and you're going to be rewarded at the end of it. I think that's awesome. When it comes to the other things that you're saying here with your strategy, I think it's great. I can definitely relate to the, living off of your income versus the 4% rule. Both come with pros and cons. It really just depends on the person. I think a 4% yield is a very reasonable yield, right? If you were looking for a 7 or 8%, I think you're going to have to reach a little bit, maybe take on a little bit lower quality portfolio. But because you're only trying to achieve a 4% yield, you can get a yield that is going to grow 7 or 8% a year. Isn't that great? So yes, you're beating inflation out of the, right out of the gate, but the important and more important thing is this 4% yield you should be looking for it to grow between 7 and 8% a year. Okay. And where did I get that 7 or 8%? That's just me being a nerd looking at investments all day. Generally, when you're getting a 4% dividend yield, a healthy growth rate is between 7 or 8%. Okay. If you had a 3% yield, you should look for a higher growth rate, maybe a 9 or a 10. So that's just kind of how I look at this, without having to reach for yield and take on a little bit more risk. Okay, so when it comes to JEPI and JEPQ for a 2-year time horizon, absolutely you can take on JEPQ and JEPI, and absolutely you can reinvest the dividends. For you, the time horizon absolutely fits. You could add a portion of your portfolio into JEPQ and JEPI. All right, let's take a look at your Excel file here. Right off the bat, I love seeing this. I love seeing how organized you are. You have a current value of just under $400,000. The percentage of your portfolio is primarily in SCHD. I don't think you can really go wrong with that. It looks like you're probably going to be transitioning some of that away, I would assume. SHD, JEPQ, JEPI, DJRW, and DJRO. So this is an all ETF portfolio. This is right up my alley. I like this. You don't have a future breakdown. Oh, combined account. Okay, so here, let me see what we got in here. So I'm looking at this for the very first time. Do you have taxable account, IRA account, dividend projections? Okay, so let's look at the combined account here. This is what you were saying here. This is the combined amount of $525,000. You have the dividend portfolio. Okay, so you have SHD. So this is with all accounts combined. This is what you have. You have 37% into SHD, 17% in DJRO, HDV. Okay, it's actually not the worst ETF. I like the low expense ratio in HDV. I like VYM and SHD a bit better than HDV. But anyways, you got JEPQ and you got JEPI in here. Okay, that's good. SWVXX. Okay. You got the yield in here, the dividend growth. I love that you're looking at the entire picture, and this is exactly what you should be doing. You're looking at what is the yield today, what are you getting today, and what are you going to be getting, or what could you reasonably assume to be getting in the coming years, and what kind of pay raise could you be expecting in the coming years. I think you're looking at this all from the right lens, from the right perspective. Okay, as it stands right now, your total, if you were to take your entire portfolio with a dividend yield of 3.88%, you can see here that your yearly dividends are going to be around $20,000, and you have a 5% dividend CAGR. Why is this so low? It's so low because of these. Yeah. I think 5%, maybe you could get this up a little bit. I have to see. But I like that you're seeing here, what you're doing here. You're forecasting this into the future, what the dividends per year would look like based off of the assumptions above. Because the cool thing about this is you're still going to be getting an income, and that income should still be growing. And I like that you're projecting this out into the future. And I think, what do you have here in DJRO? You got 17% in DJRO. What do you have in, okay, so you got, what percentage do you have in here? You have, you have 54% into SHD and DJRO. Okay. All right, so you have 37% in this money market fund, which I don't think that there's really anything wrong with that, considering where the market is today. The question is this your emergency fund, or is this something that you have on top? Do you have I guess the question that I would ask is this on top of an emergency fund? If you don't have an emergency fund, maybe you separate this out and just have this part of your emergency fund and not calculate it into your investment portfolio. I would look at them different. Emergency fund separate than investment portfolio or account. So you may want to consider if the Fed were to cut rates over the next couple of years, and if the Fed's fund rate were to go from 5.5 down to what, 2.5, or 3, you might see a dramatic decrease in your income. And so you may want to consider diversifying into maybe a JEPQ, a JEPI, or a VYM, or something that you're going to get a little bit more of a sustainable yield, because there's a lot more uncertainty with this. Now, in the short term, this is great, but if you're projecting over the next 20, 30 years, I wouldn't use this in my projection. If this was me, I would completely take this out of the equation, because this is so difficult to project. It just is irrelevant for me in this equation. So my recommendation for you, or anyone who considers, money markets in your projections, I would entirely remove this from your projections, and I would have a separate. I would view this entirely separate. Okay, so you would remove, 200,000 from this value. And so when you're projecting it, I would not go off of this amount, the 525. I would remove the 200,000 here. Okay, so that's 100%. I would not even consider that in this equation. Unless you're going to rebalance and you're going to add this money somewhere else, don't look at this. Don't use the money market in your projections here. I wouldn't recommend it. I guess it really just comes down to a simple math equation. Well, how much money do you have invested? What are you investing in? What are those yielding? And what are they projected to yield or grow in the future? And I think you're right on the right track. If you take out the money market and not include this in your projections, I think you're going to get a lot more accurate and conservative numbers. I guess the last thing that I would say is if you don't have a Roth IRA, you may consider doing, maybe a conversion. Maybe in 1 year where you're making less money, you can do a conversion and maybe pay the taxes up front. But then in the later, in later years, you'll be able to benefit from that. And if you were to do that, you would be able to put JEPQ and JEPI in a Roth IRA as an example, and you would pay zero taxes on the income. And so maybe that's the next piece of this puzzle is optimizing your accounts and where you're holding the money. SHD and DGRO, those are perfect. If you have money in a taxable account and you don't have flexibility, put SHD and DGRO in the taxable account. I think you have this here. What do you have here? So you got SHD, DGRO. Where do you have in your? Yeah. So in your IRA account, this is a individual account, so it's going to be similar to a taxable because you're going to be paying taxes in a traditional IRA, but it doesn't look like you have a Roth IRA or Roth 401k, something that you could really benefit from the tax savings. You're in a tax bracket where you're making 60,000 and you're making maybe around 20,000. If you're married and you don't have any other income, you're not going to pay any taxes or very, very little taxes. I don't know what your tax situation is, but you're in a tax bracket where you're not going to be paying a lot of taxes anyways. So the Roth IRA may actually not matter as much. Now, if you have a significant other and they're making money as well, and maybe you're in a higher tax bracket, that's a different story, but it's information that I don't have. But I guess, the last thing that I would say is just see if there's ways that you can maybe optimize this for tax purposes. But as it stands, the investments themselves, SHD, DGRO, JEPQ, and JEPI, I think these are great vehicles, great investments to rely on conservatively in early retirement. And the projections that you have here are very conservative. I like that you went with a very low growth rate, keeping your expectations low on those, I think is a smart idea. The only hole that I can really see here, or the potential gap, is how you're viewing the money market fund and how that is included in your investment account and your projections. I would remove this entirely, and I think you're in an incredible spot. So Terri, thank you so much for sending over your portfolio. Well, everybody, thank you so much for watching. I think this is incredible what Terri did here. If you're not thinking about your portfolio in this way, I would highly encourage you to think about this. Remember what I was telling, I think, John or Rory. I think I was telling this to Rory. Rory, you have 30 years before you plan on retiring. What you want to think about is how each investment account is going to help you in reaching your goal. You see here with Terri how she has different accounts. She has her IRA, she has her individual account. We saw with the other guy, I think with John, who had an HSA as well. Like, you don't want to, guys, you've heard me say this before. You're not going to pick the right stock to reach financial independence. Okay, it doesn't work like that. It maybe works like that in the movies, or maybe on Instagram. The guy driving the yacht and going from place to place on his private airplane. It maybe works for that guy, or maybe it doesn't. Maybe it's all just fake. The real way that you build wealth is having the foundation set and building upon a strong foundation, understanding your goals, understanding investment account types, and really leaving emotions out the best that you can. And that's why I talk so much about the core and satellite approach to investing. That's why I talk so much about having a core portfolio of index funds and not trying to be a stock picker, especially if you want to live off of your portfolio in early retirement. You don't need the stress of worrying about, is your dividend going to get cut or not? So I hope that the video was helpful. I hope that you learned something new, and I'll see everybody in next week's video.
Please subscribe. Subscribe. Please subscribe.
You know what? I think we're gonna be friends. Can everyone say hi to my friend? That's crazy. I just wanted to say thanks. I'm glad you came along, partner.